Investors appear bullish on Cava. The stock is up over 10% since its IPO in June. Shares rallying this month after the lockup period for insiders expired. The stock actually rising 15% on that expiration day on December 12th. Wall Street also bullish. The stock has 10 buys, 3 holds, and no sells. We're joined now by one of those analysts who is upgrading the stock to outperform today. Here with more is Nick Setyan, Wedbush Securities Managing Director. Nick, good to see you. Let's talk about Cava. You're now a fan. You moved to outperform on the name. How come, Nick? Just walk us through the argument.
Well, first, thanks for having me. I was on the sidelines just to get some visibility around, the first half 24, trends. And as we get closer to December, it's pretty clear, what the Q4 comp is going to be. So even if you just maintain a similar trajectory, we're within sort of, mid-single digits of the 26% that after anniversary in Q1. That's a huge number. But again, on a 2-year basis, even if the worst case scenario comes to pass and let's say comp is down, mid-single digits, I still think, investors are going to buy this name because that means in the back half of 24, they're going to be comping mid-single digit plus positive, inclusive of positive transaction growth. And so, to me, that's before pricing, et cetera. So the chances of Q1 being, down mid-single digits are actually pretty low. But even if the worst case scenario passes, it's still palatable for investors at this point.
So, and talk to us, when we talk about Cava, what is it that it's going to drive the growth here? Is it execution? Is it just that this Mediterranean sort of food is what people want right now? What do you think is the real special sauce, for lack of a better word, special tahini, I don't know, for Cava, Nick?
Yeah, it is a differentiated concept. There's no real national Mediterranean chain out there. It's proven that it is portable. It's worked across the country and in many states. The demographics are very similar to a Chipotle. The make line is very similar to a Chipotle, and sort of the unit economics. So average unit volumes, 4-wall margins, cash on cash returns, very, very, very attractive. And so, on top of that, year over year, for a number of years, they've been posting positive transaction growth, which for growth investors is the holy grail, right? Over 40 plus publicly traded restaurants, there's 5 that can talk about positive transaction growth on a consistent basis. And there's a lot of hope that Cava will be the 6th.
And Nick, what's the biggest risk to your call here that investors should consider? Is it grocery inflation, cooling? What do you see as potential risks that we should be aware of?
So across the restaurant space, to me, what keeps me up at night is, the grocery inflation is much less than restaurant inflation at this point in time. It's about a 3.5%, delta between the two. That has been the case throughout the second half of this year. I think that continues all the way through 2025, or at least early 2025. And that's, just California, the fast acting California, which is, $20 minimum wage for limited service across California, kicks in April 1. Everyone's going to take prices up in restaurants. And so that's a 1 percentage point additional delta, unfavorable delta for restaurants versus grocery inflation. So, we are seeing on the margins, a little bit of share shift to grocery. A lot of that trade up, sort of the aspirational trade up we saw post-COVID over the last 3 years is now behind us. So even though, across households, income brackets are seeing growth year over year, they're starting to spend within their means, as opposed to that kind of aspirational trade up that we had been seeing for a number of years post-COVID. So, I think there are a number of risks, but I think there's company-specific drivers here for Cava, not the least of which is a very favorable average check. So it's considered a relative value by many of its consumers to drive continued, comp, including potentially positive transactions by the time we get to the second half of 24.
Nick, when you talk about aspirational trade up, I think Chipotle, and that's one of the stocks that you downgraded to neutral as part of this outlook for next year. Is that why that you think that they are going to suffer as a result, perhaps, of people trading down a little bit?
I mean, I think that's part of it. Yeah, absolutely. So, again, I mean, if you think about fast casual, Chipotle, if you think about QSR, Wendy's, McDonald's, et cetera, they're a direct grocery competitor because they're, at the end of the day, they're a direct meal replacement, right? As opposed to like a full service restaurant, which is more of a social group occasion. And so, as on the margin, grocery becomes more competitive. On the margin, again, there's going to be some share shift. And relative to full service, the average check growth, the price increases we've seen over the last few years within fast casual and QSR are about 10 percentage points higher than full service. So that average check gap between the two has come down as well. So I think there's going to be a little bit of share shift there as well. That, and specifically for Chipotle, the carne asada LTO ends at the end of Q1, and we'll see what they have up their sleeves beyond that. But currently, that's what's driving transactions. That's what's driving the comp upside potentially in Q4, and that ends the end of Q1. At the same time, they're going to have to take big price increase in California. 14% of their sales are in California. Units are in California. Higher percentage of sales in California. So it's to me, that's two whammies at the same time.
And Nick, I'll get you out of here on this. Cheesecake Factory, that's another name you're now bullish on. You go to an outperform rating on that one too. It sounds like at least part of your argument there, Nick, is really a margin story.
Well, the difference between, say, a Cheesecake Factory, which is a full service, and a like a Chipotle, is that expectations are actually really low going into 2024 because casual dining has been such a laggard for so long. And what we're saying is all Cheesecake needs to do is perform in line with expectations, given where valuations are for a Cheesecake Factory. So, 7 times EBITDA for a company that is accelerating unit growth to 6-7% in 2024, has outperformed on transactions relative to the category, has a few smaller brands that are growing very rapidly, like North Italia and Flower Child, that have consistently had very solid positive transaction trends, very, very attractive cash on cash returns. And so, all Cheesecake at this point has to do is just meet expectations and the stock will go up. In the context of, small caps that hopefully continue to outperform and regain some of that discount that they've had for the last couple of years as interest rates have been rising. And so in a lower interest rate, environment, we also think, some of these smaller caps are going to outperform. Our top pick, at least on the small cap value side, is Cheesecake.
We'll keep watching all of these names going into next year. Thank you so much. Really appreciate it, Nick. Nick Setyan,
Thanks for
appreciate
having
your
me.
time.